Welcome back to Investing Talk Podcast.
Today we're looking at BMNR.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
All right, so BMNR. I think the first thing we have to say is that this company's story is, well, it's just fundamentally misunderstood by most of the market right now.
That's the perfect way to start because the numbers we've seen are, frankly, a little wild. The volatility is just insane.
It is.
But the underlying assets are enormous. There's this massive corporate transformation going on, and I think our job today is to cut through that noise.
Yeah, and figure out if BMNR is, a value trap or if there's a real multi-bagger opportunity hiding in there.
So let's just jump right into that transformation.
Okay, so if you only knew this company from, say, a year or two ago, you'd think of it as just another Bitcoin miner, capital intensive, high overhead.
Right, a traditional miner.
That narrative is completely dead. The company has made a really radical pivot.
A pivot to what, exactly? It sounds less like they're mining and more like they're just warehousing crypto.
That's a great way to put it. They've shifted to become a specialized crypto treasury and a services platform. They've gone all in on Ethereum.
Just accumulating it and focusing on staking yields.
That is the core of the new strategy. They realized the real path to scale wasn't chasing, marginal increases in hash rate.
It wasn't owning the asset itself.
Exactly. And they have built an undeniable competitive advantage, a moat, really just through sheer size.
And when we say scale, the numbers here they're genuinely staggering. They're holding over 4.11 million Ether tokens.
Right. And to put that in perspective, that's about 3.41% of the entire circulating supply of ETH.
3.5%.
Yeah.
So that makes them the single largest dedicated public holder of ETH on the planet.
As far as we can tell, yes. That level of concentration gives them serious leverage. And more importantly, a serious ability to generate consistent yield.
Which is the foundation for their next big move, right? This Melivan initiative.
The MAN, yes. The Made in America Validator Network. It's planned to launch in the first quarter of 2026.
So what is it exactly?
Think of it as an institutional-grade staking service. They're leveraging their massive scale to offer validation services to, large funds, corporate clients, anyone who wants ETH exposure and yield without the headache of running their own infrastructure.
So they're monetizing their scale. It's not just for their own staking. It's a whole new revenue stream.
A scalable service revenue stream built right on top of their existing asset base. It's a smart move, and they're still using the best parts of their legacy business to do it.
You mean the immersion cooling tech?
The same tech they developed for mining efficiency?
But how does that apply to staking? Staking isn't nearly as computationally heavy.
It's all about reliability, validator uptime.
Oh.
To maximize rewards and avoid penalties, you need near-perfect uptime. By housing their whole operation and infrastructure cooled with that immersion tech, they're guaranteeing an operational efficiency that translates directly into higher, more reliable yields.
It's a subtle engineering moat. That makes a lot of sense. So let's look at the financials then. What did the balance sheet look like when your core business is just holding a giant crypto treasury?
It looks robust. To put it mildly, we are talking about total crypto and cash holdings of $13.2 billion.
$13 billion.
And crucially, they are essentially debt-free. That number also includes a cool $1 billion in pure cash.
Wow. So they have massive liquidity.
Massive. And they're using that cash to pursue this alchemy of 5% goal, which is their plan to accumulate a full 5% of the total ETH supply.
Which just shows how confident they are in this whole treasury model.
It does. And this is where the valuation starts to get really strange.
Strange is a good word for it.
Their traditional revenue, trailing 12 months, is only about $6.1 million, which is tiny.
Right.
But the reported net income for fiscal year 25 shot up to $328 million. That gives them an EPS of $13.39.
Okay, we have to pause on that. $6 million in revenue versus over $300 million in net income. That's the asset-heavy model you're talking about, right?
Precisely. That huge net income isn't from selling services. It's driven by two things: the staking rewards from their existing tokens and, more significantly, just the appreciation of the assets themselves, the unrealized gains.
So it's like if your house goes up in value, you haven't sold it, but on paper, you're richer.
That is the perfect analogy. And because accounting rules capture that appreciation, it gives them a really high reported EPS, which just completely warps the usual valuation metrics.
And when you use that high EPS, you get this ridiculously low PE ratio, somewhere between, what, 2.07 and 2.33.
Yeah. It's almost unheard of for any kind of growth company, let alone one in crypto. It basically signals that the market is just confused.
It's still pricing it like a volatile miner.
Right. While the company has clearly become an asset-backed treasury and staking clay, the discount is even clearer when you look at its book value.
It's trading at roughly 0.80x book. So you're buying the company for 20% less than its assets are worth on paper.
Which is the classic definition of a deep value opportunity. And management is trying to signal this. They just initiated their first annual dividend.
It's tiny, though. A penny a share.
It's symbolic. It's a powerful move, positioning them as one of the first large-cap crypto firms to pay a dividend at all. It signals maturity, confidence.
And the analyst community seems to be buying it. The consensus is a strong buy. We're seeing price targets all over the place, from a cautious $47 up to $131.
That wide range just reflects the whole story, right?
Yeah.
The current discount versus the potential upside if this whole pivot works.
Which brings us to the risks, because you don't get that kind of reward without taking on some serious risk.
Let's start with the most obvious one, volatility. The stock dropped as much as 80% from its peak in July.
An 80% drop. I mean, that's enough to shake out almost any investor, regardless of the fundamentals.
Absolutely. And it tells us two things. First, the stock is still trading as a high beta proxy for the price of Ethereum. ETH goes down, BMNR goes down harder.
And the second thing,
Year-end tax loss selling. We definitely saw pressure from institutions and individuals selling off their losers to offset gains elsewhere. It causes these steep but often temporary pullbacks.
okay, so that's the market risk. Let's talk about the biggest governance issue, the thing that's really hanging over the stock, the dilution.
This is the absolute pivot point for the whole investment case. It all comes down to the annual shareholder meeting on January 15th, 2026.
Where they're voting to authorize the board to issue up to 50 billion shares.
50 billion with a B.
That number is just, it's staggering. From an investor's point of view, it's frankly terrifying. It sounds like they want to dilute everyone into oblivion.
I get it. The optics are terrible. But the counterargument from management is all about strategy and flexibility.
What's the argument?
That the authorization isn't a plan for immediate issuance. It's a tool. It's a war chest. They want that capital flexibility to fund hypergrowth, for M&A, and to make sure the Mayvan rollout is seamless.
So it's a trade-off. You accept the risk of dilution in exchange for giving them the capital to actually hit those aggressive growth targets.
It's a very high-stakes trade-off. If the vote fails, their ability to move quickly is crippled. It would be seen as a vote of no confidence.
And the stock would probably stall out.
Probably. But if it passes, even if there's a short-term dip from the fear, you could see them announce a major acquisition or partnership almost immediately.
Which would completely shift the narrative from dilution risk to massive growth potential.
And that shift is exactly what the institutional money seems to be betting on. We're seeing some really strong institutional backing here.
Why, who's buying into this volatile story?
Well, Eric Invest has been publicly noted as buying the dip. That's a huge vote of confidence in the long-term strategy. They're joined by other big names like Founders Fund and Pantera.
Okay, so the serious players are in.
And there's also been this incredible flow from overseas. South Korean retail investors have poured $1.4 billion into the stock this year alone.
$1.5 billion from one country's retail market. Wow.
That kind of dedicated flow suggests a real belief in the structural change happening at the company.
So let's look at the calendar, because there are two huge dates coming up that could decide everything.
Yes, critical catalysts. First, on January 9th, 2026, we get earnings. The consensus is for a beat driven by those staking rewards.
So the market will be watching the asset value and yield, not the old revenue line.
Exactly. And then, just 6 days later, January 15th, the shareholder vote. That's the big one.
Okay, so with those catalysts coming, let's look at the technicals. How is the chart setting up after that massive 80% haircut?
It's actually showing some key resilience. It's consolidating, building a support base right around that $27 to $28 range.
So the panic selling has probably exhausted itself.
It looks that way. Analysts are calling this a buyable base. We're starting to see higher lows form, which is constructive.
Any specific chart patterns to watch for?
There's some chatter about a potential cup and handle formation, which is a classic setup for a breakout if the January news is positive.
Interesting.
Now, some short-term models might still flash a sell signal because of the recent volatility, but the underlying institutional accumulation is telling a very different story. The momentum indicators like RSI and MEXC are bouncing off oversold levels.
So energy is building for a move.
It looks like it. We're also watching for a potential golden cross, which would be a very bullish signal heading into that Q1 Amasya van launch.
So let's try to tie this all together. What's the main takeaway for someone trying to understand BMNR today?
I think the central idea is this. You're looking at what is essentially a high-growth crypto proxy that is trading at a significant discount to its massive Ether treasury.
And the investment thesis is a trade-off.
It's a direct trade-off between two extremes. On one side, you have to accept the wild volatility that's tied to the price of ETH.
And on the other,
You get the asymmetric upside that's tied to the success of their staking pivot, and of course, that upcoming shareholder vote.
so your investment horizon here could be, what, a few weeks or a few years?
Exactly. You could look at it as a high-risk swing trade, just playing the momentum into that January 15th meeting. Or you could see it as a multi-year hold, betting that management can actually execute on Mayvan, use that new capital wisely, and hit their goal of owning 5% of all ETH.
Which, if they do it, would probably justify those triple-digit price targets over the long run. It's a really compelling but very complex situation right now.
That's it for BMNR. Make sure you subscribe to the podcast so you don't miss our next analysis.